You probably think banks just store your money, like a vault, a safe place where your dollars sit, waiting for you to withdraw them. But that's not what they do, not even close. What if I told you that when you deposit $1,000, that money doesn't just sit there? In fact, most of it disappears. And when someone takes out a loan, the bank doesn't give them someone else's money. They create new money, out of thin air, legally. This is how banks really work. And once you understand it, you'll never see money the same way again. Let's start with what a bank actually is. It's not a warehouse for cash, it's a business. And like any business, it makes profit. But unlike a bakery or a car manufacturer, a bank's product is money itself. They buy money cheap and sell it expensive. They borrow from you at low interest rates and lend to others at higher rates. The difference is their profit. But here's where it gets interesting. The money they lend out doesn't have to exist before they lend it. When a bank approves your mortgage, they're not walking to a vault and pulling out cash. They're typing numbers into a computer, and suddenly, money exists. This is called fractional reserve banking. Here's how it works. Let's say you deposit $10,000. The bank is required by law to keep a fraction of that as reserves. Let's say 10%. So they keep $1,000. The other $9,000? They can lend it out. But here's the twist. When they lend out $9,000, they don't actually remove it from your account. You still see $10,000 when you check your balance. And the person who borrowed $9,000? They now have $9,000 in their account. So that original $10,000 just became $19,000 in the banking system. The money multiplied, and it doesn't stop there. Without this system, there wouldn't be enough money in the economy for businesses to grow, for people to buy homes, for the economy to function. That bank keeps 10%, $900, and lends out $8,100, which gets deposited, which gets lent out again. This cycle continues. One deposit of $10,000 can create up to $100,000 in the entire banking system. This is how banks create money. Not physical cash, digital money. So where does money actually come from? Most people think the government prints it. And yes, the Treasury prints physical cash. But physical cash is only about 10% of all money. The rest is digital, and it's created by banks through loans. Every time a bank approves a loan, they create new money. When you pay off the loan, that money is destroyed. Money is constantly being created and destroyed. It's not a fixed supply. The Federal Reserve controls how much money banks can create by setting reserve requirements and interest rates. Lower requirements, more money creation. Higher interest rates, less borrowing, less money creation. Now let's talk about interest. When you deposit money, the bank pays you interest, maybe 1%. When they lend that money out, they charge interest, maybe 5%. That 4% difference? That's how banks make money. Sounds simple, but remember, they're lending out money they created, so they're earning interest on money that didn't exist before. Here's an example. You take out a $300,000 mortgage at 4% interest over 30 years. You'll pay back about $515,000 total. That extra $215,000 is interest. Money you earned from your job, given to the bank, for the privilege of borrowing money they created with a keystroke. This system works because of one thing: trust. You trust that when you want your money, the bank will give it to you. But remember, the bank doesn't have your money. They lent it out. They only keep a fraction. So what happens if everyone wants their money at the same time? This is called a bank run. And it's catastrophic. The bank doesn't have enough cash to give everyone. So they default. They fail. And because banks are interconnected, one failure can trigger a cascade. People lose confidence. They rush to withdraw from other banks. More banks fail. This is what happened during the Great Depression. Thousands of banks collapsed. People lost their life savings. The economy ground to a halt. This is why trust is everything. And it's why governments insure bank deposits. In the US, The FDIC insures deposits up to $250,000 per account. If your bank fails, the government makes sure you get your money back. This insurance creates confidence. People don't panic. They trust the system. But there's a catch. The FDIC doesn't have enough money to cover every deposit in America. Not even close. The system only works if most banks don't fail at the same time. It's insurance based on the assumption that disasters are rare. And usually, they are. Which brings us to the central bank. In the US, that's the Federal Reserve. The Fed is the bank for banks. When banks need money, they borrow from the Fed. The Fed sets the baseline interest rate, which affects all other interest rates in the economy. The Fed also regulates banks, sets reserve requirements, and acts as the lender of last resort. If a bank is in trouble, the Fed can step in and provide emergency funding. This prevents bank runs from spiraling into full economic collapse. The Fed also controls the money supply. They can create money by buying government bonds. They can destroy money by selling bonds. This is called monetary policy. And it's one of the most powerful tools for managing the economy. But even with the Fed, banks still fail. Sometimes they take on too much risk. They make bad loans. They bet on investments that collapse. We saw this in 2008. Banks had lent trillions in mortgages to people who couldn't afford them. When people defaulted, the banks were left holding worthless assets. Lehman Brothers, one of the largest investment banks, collapsed. Others would have followed if the government hadn't stepped in. They bailed out the banks with taxpayer money. Hundreds of billions of dollars. It was controversial. People were furious. Why should taxpayers rescue banks that made reckless decisions? But the alternative was worse. A complete financial collapse. Millions more losing jobs. The economy in free fall. So once again, the system bent the rules to prevent disaster. It was the second largest bank failure in US history. They had invested heavily in government bonds. When interest rates rose, the value of those bonds dropped. Depositors got nervous and withdrew their money. The bank didn't have enough liquid cash. They collapsed in 48 hours. The government stepped in again, guaranteeing all deposits, even above the FDIC limit. Because SVB's customers were mostly tech startups. This raises a question. Are banks too powerful? Too important to fail? Yes. Banks are the circulatory system of the economy. Money is the blood. Without banks, money doesn't flow. Businesses can't get loans to expand. People can't get mortgages to buy homes. Students can't afford college. Every major purchase, every investment, every economic transaction depends on the banking system. When banks fail, the entire economy suffers. This is why governments protect them. Not because they love banks, but because the alternative is economic catastrophe. We've built a system where banks are both essential and fragile, powerful and vulnerable. So what does all this mean for you? First, understand that money is not what you think it is. It's not a physical thing. It's a claim, a promise, a ledger entry. It exists because we agree it exists. Second, banks don't just store money. They create it, and they destroy it. The money supply is constantly expanding and contracting based on how much people borrow and repay. Third, the system is based on trust. Trust that banks will honor withdrawals. Trust that the government will step in if things go wrong. Trust that the money in your account means something. When that trust breaks, the system breaks. And history shows us that rebuilding trust is far harder than losing it. Banks are not evil. They're not heroes either. They're institutions that facilitate the flow of money. And in doing so, they've enabled modern civilization. Every city, every highway, every hospital, every school was built with borrowed money. Money that banks created. The system has flaws. It's prone to crises. It concentrates power. It rewards risk-taking until it doesn't. But it also works, most of the time. And understanding how it works gives you power. The power to make better financial decisions. The power to see through the myths. The power to understand that money is not magic. It's a system. And now you know how that system really operates.